is up, everybody? Welcome to our trade of the week. Hope you guys had a phenomenal weekend. It was a long holiday weekend. We had the markets closed today in celebration of Juneteenth Freedom Day, and also we had Father's Day this weekend. So I hope everybody had a great holiday weekend. A little bit of time off as we are going to roll into our stock pick of the week. And so let's talk a little bit about our pick of the week. We're going to talk about Tesla. That's right, Tesla. Everybody knows Tesla. Elon Musk is in the news some way, somehow, every day, right? Whether it is what he's doing with Twitter, what he's doing with SpaceX, or what he's doing smoking on the Joe Rogan show. Whatever it is, he's going to be in the news. And so Elon Musk, you can call him a lot of things. Boring is not one of them. And the stock has really been a roller coaster of movements. And so when I take a look at Tesla and really what it's done from a technical perspective, it's been really a pleasure to watch. And I will tell you, I was one of them that when Tesla from a fundamental standpoint was looking weak, I had a really hard time on the meteoric rise up. But I'm also not afraid to realize, okay, now there could be another opportunity coming back down the other side. And Tesla's been in the news a lot lately, most recently for some layoffs that occurred. There was a pretty high level firing of an LGBTQ plus leader in the organization as part of the layoffs, which Elon Musk, I think the word was the woke mind virus, was the word that he invoked. Now, whether you like it or not, agree, disagree with whatever he did, that's not the relevant point. The relevant point is that he's in the news again, and it's not necessarily a good thing that they're in the news for, right? The other side of it is the economy is just shrinking a little bit. And the idea of somebody buying an $80,000, $90,000, $110,000 car is being a little bit challenged when we see that the stock market is down 35% and people's portfolios are getting pummeled. And so all this to say, there could be an opportunity on the bearish front for Tesla. So let's take a look at it from an options perspective. We're using the TradeHawk platform by Tradier. If you guys are not familiar with Tradier, go to tradier.com. They have a really great program for options traders. $10 a month for essentially unlimited options trading, no commissions, which is really kind of cool. So go take a look at it. Let them know that Chuck Fulkerson sent you from tradersarmy.com. And let's go ahead and dive into the charts for Tesla. All right, so here we see the Tesla on a daily chart. And certainly on a daily chart, we can see that we are in quite the downtrend, right? Consecutive lower swing lows, consecutive lower swing highs. We were able to put in a fairly nice rally up here recently, right through this region here, but unable to capitalize on that and continue the rally higher as we got another drop and unable to lead us to a new higher high. So this tells us that I believe that our better probabilities for price to continue to trade lower. Now, one of the things that I always tend to take a look at is what are we sitting at from a support line setup? And when I look at this overall, the thing that I am most interested in is really taking a look at this support line right here, as well as these lower highs right through here. So these lower highs right through here, bouncing off this support, creates a little bit of that kind of descending triangle look that I'm a big fan of identifying and finding. And so one of the things that I want to be able to do when looking at this overall is to say, all right, well, what does that look like? That's a daily chart, but what about a weekly chart, right? What does a weekly chart tell us as far as where price could go? So giving us a bit more context, if you will, as to where price can go. We're sitting here now at about $650 a share, getting as high as $12.50. So the market, it's down essentially 50% from its high. But as I look at this, where I see the probably most probable move down would be into this level right through here. And I don't have my Fibonacci's set up on here. Let me get rid of that, actually. Let me do my price channel. There you go. So I would think that this level right through here would be a really good target area as the origin of a strong move up. And so I think there's a really good chance for price to drop this low. But the question is, how do I trade it, right? What is it that I can do as far as a good probable trade on this? Well, in order to do that, what I need to do is I need to take a look at the options charts as well as the volatility. So I'm going to put my volatility channel on here. And so what my volatility channel tells me is, where are we relative to the last 1 year's worth of volatility. And we can see that right now Tesla is in about its highest volatility range. Anytime we're in the red, remembering that if we're in the red, we want to be options sellers. If we're in the green, we want to be options buyers. And when we're in the white, in between, we want to be spread traders of options. And so in this case, I want to be an options seller. Now, in being an options seller, the most common thing that you would sell would be you could either A, sell a put at a place you're willing to acquire Tesla, or B, sell a call above current price. I'm not comfortable selling a naked call in Tesla, I've got to say. And so I would still be doing some sort of a call spread if I'm going to be trading Tesla, or we can look at the put opportunities. So let's go take a look at our what if chart. So looking here, we're going to go to menu, positions, new empty position, and we're just going to call this the Tesla bearish setup. And we will just call this, the underlying is Tesla and create. Okay, so let's first look at the bear put spread. And when I look at the bear put spread, in order to do the bear put spread, I'm going to add an options trade. And let's go out into, so we're doing this on June the 20th. We're looking at this on the evening of June 20th. Looking at June 24th is not going to give me really enough time to do much. 7-1, I don't get as much theta. 7-4, I get a little bit of an extra day of time decay from the 4th of July. But I'm going to go out to 7-15, and 7-15 I think is going to be really where I want to look. And let's go all the way down to the 750 strike. Now, currently we're trading at about 650, so that really gives me $100 to be wrong. I'm going to sell the 750 call, and that's going to bring me in about $16, around $17 per share. And I'm going to buy the 755 call in order to protect it, okay? So in this case, we're doing the 750 by 755. I could do the 750 by 760s. Actually, let's do the 750s by 760s. We'll do a $10 spread. We'll look at both. There we go. So the 750s by 760s, my risk graph in this case, looks a bit like this. So by doing the 750 by 760s, we're selling the 750 for $16.95. We're buying the 760 for $15.20. So that's a $1.75 delta, $1.75 spread between the two, right? The difference between the two in this case is going to be about $1.75. So when I look at that, the 750 by 760, when I look at the actual table and see, okay, what does that mean for a P&L on my expiration date of July 15th? That says that if the stock is sitting anywhere below $750 a share, your profit is going to be about $175. Now, if it goes against you, you lose $825. So you may say, well, that's not a very good reward to risk. In this strategy, we're not really as concerned with reward to risk as we are concerned with the rate of return on the money that we're investing. So how much money is being tied up? Well, in this case, we're tying up $825, and we're bringing in $175. So one of the things that we look to do in that case is we calculate the rate of return. So the best way to calculate that rate of return is to take the amount of money being tied up by the return. So $175, all right, divided by the 825. Now that would be a rate of return of 21.2%. And that 21.2% is going to be given in under a month. So 21.2% rate of return in under a month. My number that I look for is a 15% rate of return. If I can get above 15, I think that's pretty good. Now, that means that I've got prices can go up $100 a share, and I'm still going to be okay. My position that I really have to worry about is if price gets up above the $750 line. So if we get up above that level of 750, that's where I need to be concerned. Well, what's great about that is that I've got this pivot high right here to be part of it. I've also got this level up here. Now, if price drops faster below here, we may see a little bit of an acceleration in our profits pretty early. And if our our position makes money faster as the price falls, then we certainly want to close that position out a bit early. So this is one way to make this trade, and I think this is a pretty effective way to do it. But what's another way? Well, another way might be to say, well, what if I think that looking at the weekly chart, that there is a really good buying opportunity, right? What if you really believe in Tesla and you think that somewhere down here is a good buying opportunity, a little bit lower below current price? Well, how do we do that? Well, in that case, what we're going to do is we're going to use the options positions in order to find a really good place to sell a put. Now, when we sell a put, our rule basically says this: I want to sell a put at a place where I'd be willing to own the stock, and I want to have a delta of around 0.15. A 0.15 delta is going to be the ideal delta on these positions. So going out to July 15, and when I find the 0.15 delta, I'm going to be right at about $510 is going to be my 14 delta on that put. Now, what's that going to pay me? So the next thing I need to know is, what is that going to pay me? It's paying about $13 a share. So the 510 put is paying about $13 a share on that position. So when I look at the risk graph on here, that $13 a share that position is paying me, and let me go to current price. In this case, we would want price to stay above a certain price level. And in that case, you're making $1,300 per contract. Now, that $1,300 that you're making per contract is against the risk of what's being tied up. That's going to be very specific to your broker and to the structure that you have put in place as far as what your margin requirements would be to sell this $510 put. Now, that $510 put really puts you on a daily chart at a level where price would have to fall all the way down into this region. Somewhere down into 510 would be kind of the area where you might look to say, all right, well, this would be where it's no longer going to be tenable. And then we would talk about, what does the rolling strategy look like? How would I roll that down? Ultimately, we think that the good buy is around 450. So as price would get closer to that 510, what we would do is say, well, if our delta of this 510 short put gets to be about 35, then we'll look to roll down and out. But in the meantime, this is a $1,300 credit to your account that you can, sets you up, but you've got an obligation to buy the stock at 510. So the question then becomes is, how much capital does this tie up and what's my rate of return? Well, very similar. What we're going to do is, looking at our calculator, in a lot of brokers, it's going to be about 10% of the underlying that's tied up. So at $510, right, times 100 shares, it's tying up $51,000. Well, but 10% of that, right, divided by 10 is going to be $5,100. Well, if I'm getting a $1,300 return divided by the $5,100 of capital that's being tied up, that's about a 25% rate of return. And so it's a slightly higher rate of return than the bear call spread. The question you have to ask yourself is it worth the risk to sell the put for a slightly higher rate of return than it is to do the bear call spread? And ultimately, that comes down to your overall outlook on how bearish do you think that Tesla is going to be. If you believe in Tesla and you think it's going to be a good stock worth owning, you might want to sell the 510s. Buying the stock at a significantly lower price, it allows you $140 worth of movement against you before you start losing money. Whereas if you believe that it's still going to be bearish, you've got $100 of wiggle room the other way. Now, could you do both? Absolutely, you could do both. And essentially what you put yourself then into is in a bracket where realistically you're going to make money on one of them. And chances are that you may make money on both if it stays between the 510 and the 750. But once again, you've got to understand options and the risks that come with that play. So hopefully this trade makes sense to you. If you have any questions, send us an email, support@tradersarmy.com. Leave a comment down below. I'd love to hear what you have to say about this trade and this idea. Until next week, everybody, hope you have a great week. See ya.